Hello everyone. Welcome to my channel. Today is Thursday, August 28th. The overall stock market closed higher today, with the S&P 500 hitting a new record high in the lower and closing levels. The Dow Jones Industrial Average rose 0.32%. The S&P 500 rose 0.24 and the Nasdaq rose 0.21%. Unfortunately, Nvidia's post-market financial report did not meet Wall Street's expectations, resulting in a current post-market decline of around 3%. So the US stock market failed to avoid Wednesday's disaster. The next challenge will be the PCE report, the inflation indicator that the Federal Reserve is most concerned about on Friday. In today's video, we will take a detailed look at Nvidia's financial report and identify the details that need our attention. The most important thing is how to proceed next. Although Nvidia's second quarter financial report for the 2026 fiscal year exceeded market expectations in terms of revenue and earnings per share, given its current valuation, investors are expecting a perfect report, so today's results are far from enough. However, this also conforms to the pattern of the past year, where Nvidia usually releases so-called sell news after its financial report, resulting in a slight decline in its stock price. But this financial report is different. Friends who have watched our in-depth analysis video of Nvidia before must remember that we mentioned that from the end of this year to the beginning of next year, Nvidia will face a significant slowdown in revenue growth. The reason is also very simple. The past 2 years have been the peak period of income growth. So when comparing year-on-year next year, income growth will further slow down from the current growth rate of over 50% to around 20% to 30%. Therefore, as investors who look at expectations, they will start rating the stock price in advance. And in today's financial report, this risk was brought to the forefront by the company, leading more investors to become aware of this potential risk. We will further discuss this future issue later. Let's take a look at today's financial report. In the just concluded second quarter, the company's adjusted earnings per share were $1.05, exceeding market expectations of $46.74 billion in revenue and $46.06 billion in revenue. That looks good on the surface. But by looking deeper at the performance of different departments, we can see where the problem lies. The revenue of the gaming business department was $4.3 billion, a year-on-year increase of 49%, exceeding the expected $3.82 billion. The revenue from professional visualization business was $601 million, a year-on-year increase of 32%, which also exceeded the expected $532 million. Automobile revenue was $586 million, a year-on-year increase of 69%, but lower than the expected $593 million. The most important data center business, which is the high-speed growth business driven by AI, had a revenue of $41.1 billion this quarter, a year-on-year increase of 56%, but lower than the market expectation of $41.29 billion. And this is also the second consecutive quarter in which data center business revenue has fallen below market expectations. So looking at it this way, the problem is very obvious. Although the company's overall revenue exceeded expectations this quarter, the reason for the excess was not what the market expected, because investors hope to see data center revenue continuously exceed expectations. This reflects that the enthusiasm for AI is still ongoing rather than being driven beyond expectations by revenue from other departments. Because the current valuation of the company is entirely based on the growth of the data center department, rather than other departments, especially since this department has underperformed for 2 consecutive quarters. If one quarter is a coincidence, then 2 consecutive quarters will naturally raise more concerns among investors. And more people will ask a question: does this mean that the investment cycle of AI hardware has started to slow down? Of course, it is too early to draw a conclusion now, as these 2 quarters have been disrupted by the Chinese market. However, it is enough to cause some concerns, which naturally led to some fluctuations in stock prices after hours. Therefore, there are significant variables in the Chinese market now. In the second quarter, Nvidia did not sell H20 chips to any Chinese customers. However, during the quarter, they sold approximately $650 million worth of H20 chips to customers outside of China. Moreover, in the recent conference call, the company stated that Nvidia's sales in China have stagnated due to the US government's delay in issuing export licenses. However, if they can obtain the licenses in a timely manner, their H20 revenue in China in the third quarter is expected to reach $2 to $5 billion. Moreover, Huang Rengson also said that he has been discussing with the Trump government to expand access to the Chinese market. And he believes that there is indeed an opportunity to bring the most advanced Blackwell chips into the Chinese market in the future. For the outlook for the next third quarter, Nvidia currently expects revenue of $54 billion, with a fluctuation of 2, slightly higher than the market's general expectation of $53.46 billion. However, it should be noted that some analysts' previous expectations were as high as $60 billion, so it cannot be considered a particularly perfect answer. However, even so, revenue continues to grow. They also expect the gross profit margin for the next quarter to be 73.5%, with a fluctuation of 50 basis points, slightly higher than the final expectation of 73.4%. In short, the outlook for the third quarter is similar to that of the second quarter, both exceeding average expectations, but not to a particularly good extent, which is certainly not enough in the context of such high valuations. However, it is worth noting that the company's third quarter outlook does not include any data center revenue in the Chinese market. So the performance in China may still bring us unexpected gains. Although Nvidia is currently facing dual pressure from US export restrictions and Chinese countermeasures in China, the company expects that there will still be a large number of Chinese customers purchasing chips after obtaining licenses, especially considering policy uncertainty. Many companies are likely to stockpile large quantities in advance, as the current domestic AI chips in China are not enough to support the demand of Chinese AI companies. Before moving on to the next section, let me share some good news about giving away Nvidia with friends. We have partnered with TradeUp Tiger Securities USA to bring you the activity of giving away one Nvidia stock. Now, new users in the USA only need to deposit $2,000 to receive one Nvidia stock. In addition, you can also get 2 to 5 free stock lottery opportunities, up to a maximum of $9,000. At the same time, there is a maximum of 3% cash refund and $300 handling fee reimbursement for warehouse transfers. I will place the link to the event in the introduction section and top comments. The event time is limited, so friends should not miss it. Okay, let's get back to the point. Huang Rengson commented on this quarter's performance, stating that the global demand for Nvidia's AI infrastructure is very strong. And it is expected that as more AI agents become mainstream, the demand for AI computing will accelerate. In this chart, we can see the astonishing growth of Nvidia's data center business, which is also an important reason why the company is currently able to maintain a high valuation. But the risks we mentioned at the beginning of the video also happen to be within this business. The biggest pain point of today's financial report is the data center, as it not only failed to meet market expectations for the second consecutive quarter, but also experienced a month-on-month decline. Although investors still expect the business to accelerate again in the coming quarters, but the issues of this quarter are enough to raise some concerns, especially in the current valuation context where no mistakes can be tolerated. In this chart, we can see more clearly that after the company's revenue took off in 2024, the growth rate has been continuously slowing down. This is precisely because the previous performance is becoming increasingly difficult to surpass, and the revenue growth driven by the data center business continues to slow down. We are currently in the second quarter of the company's 2026 fiscal year, and the market's expectation for the next 2 quarters is still around 50% growth rate. But starting from the fiscal year 2027, which is next year, the company's performance has already reached a peak. Wall Street analysts currently predict that the company's revenue growth will slow down to 28% starting from fiscal year 2027. At that time, investors will begin to ponder whether a company with a revenue growth rate of around 30% should still have a P/E ratio of around 60 times. even though the company's fundamentals are sound and its overall revenue is constantly increasing. Therefore, even if there is no bad news for the company at that time, it is likely to face a wave of valuation re-rating, according to Goldman Sachs' previous predictions on global AI hardware investment. They estimate that by 2026, which is next year, AI hardware investment will reach a peak of 2% of global GDP. We don't have to worry too much about the accuracy of this number. What we care about is when the cycle reaches its peak and begins to slow down. Assuming their prediction is correct, next year will be the peak of global AI hardware investment. And there is a high probability that orders for these chips will occur in the first half of next year, if Nvidia receives these orders in the first half of next year. It is expected to be reflected in the second or even third quarter financial report, starting from the second half of the year's financial report. Such as the third or fourth quarter, we will see a significant slowdown in revenue. Currently, Wall Street expects a revenue growth of around 30% for the full year of next year. So if there is still a rapid income growth in the first half of the year, it means that it is likely to drop to 20% or even lower in the second half, given that investors are all based on expectations. We can roughly estimate that from the second quarter of next year, which is the second quarter of Nvidia's 2027 fiscal year, the company will enter a period of transformation, and investors' ratings are likely to occur around this time. Of course, the exact timing is difficult to predict, as we have already seen in today's financial report that investors have noticed this issue. But given the current market frenzy, it will not enter the re-rating of valuation so quickly. Therefore, I expect to start around the first half to mid-2026. So in fact, we only have about half a year left to brainlessly add Nvidia's window. In the coming quarters, what will be more important than the Chinese market is whether the updated and more expensive Blackwell chips can be accepted by the market. During the conference call, Nvidia's CFO stated that we are continuously improving the performance of our Blackwell architecture, which has grown by 17% quarter-on-quarter this quarter, including our latest Blackwell Ultra architecture. Blackwell's revenue covers all customer categories, with large cloud service providers leading the way, accounting for about 50% of data center revenue. This refers to those large technology companies that invest heavily. So in other words, whether Nvidia's stock price can continue to rise in the next few quarters depends entirely on these big technologies, whether Microsoft, Google, Meta, Tesla, and others will continue to purchase large quantities of Nvidia chips may not wait for Nvidia's own performance to slow down. As long as these companies mention reducing expenses in their financial reports, Nvidia's stock price will quickly undergo a re-rating. So that's why we just calculated Nvidia's valuation from the perspective of global AI hardware spending, and currently Nvidia has fallen to around 175 after hours, which happens to be a key support level. So as long as we don't fall below this level, we can still boldly increase our position. The upward trend has not been broken yet, and it is still safe, but if it falls below this level, especially with a large trading volume, then we need to be careful. The next support level is in the range of around 150 to 155, and holding on to this position is the next time to increase positions. In short, we should never buy this stock just because we want to. Although the overall fundamentals are still good, now risks are starting to rise, and we must rely on technical analysis to make cautious operations, and we can notice that in the past month the stock price has basically stagnated. That's partly because the stock price has already fully priced in all the current favorable factors, and also because many institutional investors are waiting for this financial report before making future trades. Therefore, now that the results are available, the institutions will begin their operations. As we mentioned before, September is the worst seasonal month for us and Chinese stocks because institutional investors start returning to their positions after summer vacation. After coming back, we will adjust our position. One of the main operations is to take profits on stocks that have risen sharply, or in other words, partially take profits. Then Nvidia naturally became one of the targets. So it is expected that the long-short battle will continue in September. There will be significant selling pressure on the institutional side. This is mainly due to some institutions taking profits, especially many professional investors who will further rotate their sectors and invest more funds in sectors that are more sensitive to interest rate cuts. During this process, retail investors are expected to continue their frenzy of buying Nvidia. So it is highly likely that Nvidia will continue to experience volatile market conditions in September. But in this market situation, there will naturally be many opportunities to increase our holdings. Therefore, as we just mentioned, as long as each pullback can maintain a stable support level, we can boldly increase our holdings. Because from the perspective of the next 6 months, the direction of the stock price is still upward. But in the first half of next year, we will start discussing the fundamental issues of the company. As the problem of slowing down revenue will become more apparent at that time, more investors will pay attention to the re-rating of valuations. And at that time, the stock price correction may no longer be a temporary cooling, but a complete reversal, just like in the later stages of every Nvidia growth cycle before. In short, the company's fundamentals are still good now. So we don't have to worry, we can still buy on dips. Early next year is when we need to become more cautious. The next challenge for the US stock market is Friday's PCE inflation report. At present, the market expects the Personal Consumption Expenditure Price Index to remain high in July, and economists predict that PCE will increase by 2.6% year-on-year and 0.2% month-on-month in July. After excluding volatile food and energy, the core PCE increased by 2.9% year-on-year and 0.3% month-on-month. Although the inflation rate has significantly decreased since reaching its peak in the summer of 2022, the price increase is still higher than the 2% target set by the Federal Reserve to stabilize the economy. Morningstar economists state that a core inflation rate of 2.9% is a new upward trend and point out that the latest trough was in April of this year. At that time, it was 2.5. He also emphasized that the uneven implementation of tariffs in recent months means that the impact on monthly inflation data will be a lengthy process. So it is expected that the central bank will not be too surprised by the new data. The Federal Reserve is aware of the impact of tariffs on the direction of inflation. But the uncertainty now lies in the magnitude. And the bigger question is whether the increase in inflation caused by tariffs is temporary or the beginning of an overall shift in direction. Looking deeper, the economist also pointed out that commodity prices usually remain flat on a month-on-month basis and even show negative growth. But in recent months they have been steadily rising at a rate of 0.35 to 0.4 percentage points per month. This is important because it will definitely bring great upward pressure to consumers, especially as the inventory of each tariff continues to decrease. Companies will start to pass on these costs to consumers, therefore it can be expected that core commodity prices will continue to remain high. And he is more concerned about the recent increase in service prices, which was reflected in last month's Consumer Price Index report. The report shows that housing costs, airfare prices, and healthcare costs have all increased. He said that if inflation spreads to service prices, it will be a bigger problem for the Federal Reserve because its stickiness may be much higher than commodity prices. In short, it is expected that this inflation report will not change the market's expectations for a rate cut in September. At present, the market expects the probability of interest rate cuts to be close to 90. There has been a further increase since Powell's speech last week. So, the market basically concludes that even if there are some changes in inflation before the September meeting, it will not change Powell's determination to lower interest rates once first. The more important question is how inflation data will develop after that. If stability can still be maintained, the Federal Reserve can cut interest rates again in December, but if there is a significant rebound, the interest rate cut cycle is likely to have ended just as it began, and the cost of imported goods is certain to rise. It is uncertain how much each major retailer will pass on to consumers. In theory, they will 100% pass it on. However, under the current pressure of Trump, many enterprises may choose other ways to absorb tariff costs, such as sacrificing their profits or forcing suppliers to reduce prices to bear costs. Now it seems that major retailers will not dare to let consumers bear most of the tariff costs. So I expect inflation to rebound in the coming months. But the magnitude will be very restrained and will not significantly affect the Fed's interest rate cut cycle. Therefore, the outlook for the US stock market in the coming year is still good. But the upward trend will be more balanced because interest rate cuts will stimulate more interest rate sensitive sectors. So these sectors are likely to rise together with big technology rather than the scene where big technology dominates as we have seen before. This is precisely why we are seeing some Wall Street hedge funds undergoing significant sector rotation now. And we will also discuss some sectors and stocks that are more sensitive to interest rate cuts besides stocks in the technology sector. Okay, that's the content of this video. At the end of the video, we also want to remind our friends that our membership videos are constantly being updated. In the member channel, we not only provide more in-depth analysis, but also have long-term predictions and prospects for some individual stocks. For example, in the previous in-depth analysis by Nvidia in May, the target price of $190 for the next year that we provided may have seemed unrealistic at the time, but now it seems entirely possible. In addition, the summary of insider trading by executives and the summary of stock recommendations by Wall Street bigwigs are constantly being updated. We will summarize and screen the stocks that have greatly increased in value by internal executives, as well as the stocks strongly recommended by the most accurate analysts on Wall Street. Here, you may be able to find the next stock you want to buy. Finally, for members who have questions about the market or individual stocks, as well as any other issues, we have dedicated personnel to conduct in-depth analysis and provide you with a comprehensive response and detailed operational recommendations. I will put the link to join the membership circle in the introduction bar and the comments at the top. Interested friends can take a look. Okay, the above is the content of this video. If you have seen it here, please remember to leave me a like and kindly leave a manual like in the comment section to let more friends see this video. Thank you for your strong support all along. See you in the next episode.